Everyone is watching Bitcoin around the $60,000 area, but the bigger warning may not be coming from Bitcoin alone. The real signal is that the market is starting to question the entire risk trade at the same time. AI stocks were supposed to be the leadership engine, Bitcoin was supposed to be the liquidity escape, and tech was supposed to carry the next leg higher. But when all three begin to weaken together, the message is not just about one chart, it is about confidence. This week, the pressure started showing up in the places investors used to trust the most. Semiconductor stocks cracked, AI names lost momentum, and the market began asking whether the artificial intelligence boom is already priced too perfectly. The problem is not that AI is suddenly dead, because that would be too simple. The real problem is that Wall Street is starting to ask who pays for the massive data centers, the chips, the power demand, and the debt behind the dream. At the same time, Bitcoin is no longer acting like a clean escape from the stock market. When liquidity is strong, Bitcoin can look independent, powerful, and unstoppable. But when institutional money becomes defensive, Bitcoin often starts behaving like the most emotional version of the risk trade. That is why the recent weakness matters, because it is not only price moving lower, it is ETF demand and investor appetite cooling at the same time. Here at the Calm Metrics, we do not treat price as the full story. Price is the surface, but liquidity is the message. And right now, that message is getting more selective. Investors are not abandoning every asset, but they are becoming more careful about which stories still deserve capital. That is exactly why AI, chips, Bitcoin, and tech funds need to be watched together, because they reveal whether this is just a dip or the beginning of a wider risk reset. The dangerous part for retail investors is that every sharp decline looks tempting when the previous trend was strong. A falling AI stock looks like a discount, a weak Bitcoin chart looks like a buying opportunity, and a red market feels like the place where brave money should enter. But professional money does not ask only whether an asset is cheaper today. It asks whether the next buyer is still there, whether liquidity is still expanding, and whether the risk-reward still justifies staying exposed. So the next signal is not one single headline. Watch whether chip stocks stabilize, whether Bitcoin can defend the $60,000 area, whether ETF flows stop bleeding, and whether the Nasdaq can recover leadership instead of just bouncing for a few hours. If those signals improve together, the market may rebuild confidence. But if AI keeps cracking while Bitcoin keeps warning, the lunch hour story for investors is simple. The market is not only selling risk, it is testing who still believes in it.